Hello, everyone. This is Stock Market Daily. Thank you for joining me today. It is August 3rd, 2023. So, last couple of days were pretty interesting. Out of nowhere, we received a credit rating downgrade on the US government by Fitch, and the stock market sold off from there, obviously. I'm not going to go into detail what it means. If you know what it means, great. If you don't know what it means, the simplest way I can explain it is think of it this way. If you had a credit score of 800, let's say, and you didn't pay some of your bills or something else happened, and the credit rating agency now thinks that your credit score should be 730, let's say. So, what is the result of that? The result of that is that you are going to, if you're going to go look for a loan, your percentage that you're going to pay for the loan is going to be higher than it was before, as creditors are going to think that you are more risky to lend to. Okay, so that's probably the easiest way to explain it. Why does it matter for us if the US government goes from a AAA to a AA? Well, simply because everyone's affected who is in the US and outside the US as well, simply because just it's basically a silent interest rate hike. Um, Basically, if our rates for the government are going up, that means that our rates for consumers and businesses also probably will have a tendency to go up slightly based on this, as creditors are going to see the US as a slightly more riskier asset to invest in. Last time this happened was in 2011, and we had a pretty mild, almost nothing burger come out of this downgrade compared to 2011. 2011, the market sold off 6 or so percent. So I definitely sold some puts yesterday here. One of them got trapped in the money and then basically came out, but I already rolled a position. I'll show it to you here in a minute. And today, obviously, we had another little bit of a gap down, but that didn't last too long. We hit a low of 44.85, which was interesting to see. The S&P being below the 5,000 level. I thought that we may stay there, but that did not come to fruition. We actually ended up closing the gap and sold off slightly back to 4,500 level. Let's take a look at the trades. So I did have the 44.90 position that I rolled from yesterday, and obviously that went out of the money, and I actually bought it back just in case we did have a downturn at the end of the day. So I bought that position back. That's why you don't see it here. This one I sold today, 44.60. Let's take a look. So I sold that 44.60 for $210. And I did close out the 44.90 for $15. Here I bought two $3,000 puts dated on August 16th because mine expired today, so I could continue doing the strategy that I'm doing. And I did have 3 SPX call options. So I did do this one in the morning. It probably would have been better if I waited, but probably not by a lot. This one was all the way in the money. I mean, we're talking 4,285 call. I had 2 of these. I rolled it to 4,295. 4,295. So $10 strike price difference, and I collected $80 premium on each of the contracts. So $160 profit on that. Let's see what's next. Then we did we rolled a SoFi position. And finally, here's the call that is really close to being out of the money on the SPX. On the call side, I had it at 44.70, which was expiring today. I was going to hold it until the end of the day. It definitely had premium on it in the morning, so I wanted that premium to expire. That's just kind of um, the game you have to play. In the morning, there's premium on this option. You can roll it when the market is going down. You know, the market is going down. You can roll it, but then you are paying for premium that's going to be expiring today. So you wait, and then the market reverses and goes up. But thankfully, you know, when we did go up, we hit this resistance level 1-2 times and sold back to 4,500. Right about here, I decided to basically roll the position, and I had two options basically to roll it into. And the reason why I did it here is because I didn't want to, you know, yesterday we had a major sell off and then a huge bounce. So when this started kind of happening here, I decided that I'm just going to roll it. So my two options on what I could have done with this option was I could have rolled the 44.70 into tomorrow. I could have collected something like $250 and as premium, and but I would have only been able to roll it into 44.75 strike price. The second option is 44.85, which is right here, but all the way on Monday, and collected $20 premium. So the catch is obviously what's the market going to do tomorrow? We have obviously earnings data, and you know, pretty big earnings from Apple and Amazon, and we're still in this continuation of a downtrend from this downgrade for the U.S. government. So I had to make a decision. Do I only roll it at a 5 strike price difference for tomorrow? I mean, it's possible that we're going to hit 44.75 or get very close to it, because we were as low as 44.85. I mean, $10 difference here is not that big, especially if both Amazon and Apple did horrible on their earnings. Or trade it, roll it into Monday, take the higher strike price of 44.85 and not collect pretty much any premium on it, just $20, but have a little cushion because it is a higher strike price by another $10. So I decided to bite the bullet, obviously here, roll it into Monday at a higher strike price, simply because my assumption was if we did have a down Friday, that we might as well have a down Monday. So down Friday, down Monday, obviously depending on the data and the earnings. So it was a 50-50 chance. I figured that might be a more of a plausible probability. If we have an up Friday, I probably wanted to be at a higher strike price. So that was my rationale there. Let me know in the comments what you would have done or how you would have played this. It was a 50-50 chance. I could have done either or. Very good chance that we're going to come down to 44.70 tomorrow. Very good chance that, you know, on Monday we're going to bounce and I'm going to miss the opportunity to get out of this thing. But this is what I did for this option. Now, speaking of earnings, we had Amazon earnings that they did really well. Well, I'm not going to show you the charts. I'll briefly go over it. Amazon did really well. They are currently at, let's see, they're currently at 140.33 and they closed at 128. So did really well. The market really liked it. They kind of bounced up, made the S&P bounce up a little bit. However, Apple had some misses on pretty much all of their tech, iPhones, iPads, wearables, but the services made up for it. And the stock is trending somewhat lower. They're at 187.40 and closed at 191. So the futures are pointing a little bit higher right now than what we closed at. So it's going to be an interesting day tomorrow. Let's see who wins. Let's see if Apple has the ability to kind of hold its price over here, or if Amazon starts ripping. And we do have a little bit of data coming out, so it's going to be an interesting day. Hopefully, there's going to be more volatility because the actual premium on SPX was definitely back up there today. I saw the implied volatility on the SPX was a little bit over 17%, and you could have actually finally collected about $400 or so on a 22 delta, 23 delta put option. So that was cool to see. So we're back at it a little bit. So that's great. And obviously, if there's more volatility, even if you are trapped in these positions, let me go a little further out. Even if you're trapped in these positions, like this one, for example, the extra volatility is definitely going to help because it's going to bring some more extrinsic value to these options here. So you're going to be able to roll the position a lot easier and at better strike prices. Okay, so thanks for joining. We'll see you tomorrow and have a good day. Bye-bye.